So let us look at what the 2017 commentary to the treaty says. And I'm not sure that this paragraph is applicable, but I quote it for you nonetheless, because it says where a payment is in consideration for the transfer of full ownership of an element of property referred to in the definition, the payment cannot represent a royalty because you're transferring full ownership. Now, this doesn't match with letter B, where they say that if you sell a part of something that could generate royalties. If you look at Article 12, then that payment or that capital gain is royalty as well. But it goes on to say each case will depend on its particular facts as regard what constitutes an alienation. But in general, if the payment is in consideration for the alienation of rights, such payments are likely to be business profits within Article 7 or a capital gain within Article 13 rather than royalties. And this is interesting because if Boulez argued that this was a capital gain, then Germany would have been able to tax, one assume, and not the US, right? But again, what the court said, and I've not quoted that part, but the court said, until he conducted and the recordings were made, there was no property. I would disagree with that. I think the property is Boulez as he performs, as he plans he's performing, as he maps out his performance. I'm sure that he doesn't just go and perform and improvise out spot. I think this is very carefully thought out before. And that is where the performance was created, and he still has those papers, but none of this was discussed by the court. And the OECD guideline says the essential character of the transaction as alienation cannot be altered by the form of the consideration, the payment of the consideration in installments, or by the fact that the payments are related to a contingency such as sales. Now, I've not reviewed whether these commentaries came in after the Boulez case or not. It is quite possible. What is very clear is that the next paragraph refers to the Boulez case. At least that's my interpretation. And here it goes both ways. It says suggestions made above regarding mixed contracts, and this is about software, could also be applied regard performances by artists, and in particular in regard to an orchestral concert given by a conductor. Right. The fee for the musical performance, together with that paid for any simultaneous radio broadcasting thereof, seems to fall under Article 17, which is performance by artists. And quite frankly, if the US have argued performance by artists, Article 17, that could have made a lot of sense as well, right? So rather than services, I don't know if the US-German treaty had such a article. And the current commentary to Article 12 then goes on to say, where the musical performance is recorded and the artist has stipulated that he, on the basis of his copyright in the sound recording, be paid royalties on the sale or public playing of the records, then so much of the payment received by him as consists of such royalties falls to be treated as Article 12. Right? And now you think, okay, so this means that Boulez was right. These were royalties, and Germany then. However, then the commentary goes on to say, however, where the copyright in the sound recording, because of either relevant copyright law or the terms of the contract, belongs to a person with whom the artist has contractually agreed to provide his services, like a musical performance during the recording, payments may be made under such contract. Payments made under such a contract fall under Article 7 or 17. And again, in both of those cases, the US would be able to tax. But so here's clearly a case that led to juridical double tax with seemingly no way to get out of it. And the question, if especially paragraph 18 is correct, would be, what did Germany then argue about the royalties, and what about works of other authors? I mean, if I conclude a contract with a Dutch publishing house such as Wolters Kluwer to publish a book about tax, and they keep all the copyright for it, but they pay me royalties based on the sales, and I actually go and spend a month in Jamaica to write the book. Does this then, by the Boulez case, mean that Jamaica has the taxing rights. It seems unlikely to me, but it seems to me that that is the logical conclusion of these papers. Now let us look at a few other cases. In the next couple of cases, I want to talk to you about legislation which potentially overrides treaties and which potentially leads to juridical double taxation. And there were three cases in the Netherlands in this regard, which I'd like to discuss. The first one, you see the official case numbers, etc. here, and it dealt with the following situation. You have Belgium and Holland. You have a Dutchman moving from Holland to Belgium, but he still has his own Dutch BV and he still runs his own business. And in the year at stake, the Dutch tax authorities said, you know, you worked for your company, but you didn't pay yourself any salary. And there's Dutch anti-abuse legislation which says that if you own more than 25% of the shares of a company and you work for that company, you will be allocated a salary which is at arm's length, basically. So the Dutch tax authority allocated, I think, approximately 75,000 euros to this gentleman. And he fought the decision. He said, under the Belgian-Dutch treaty, you cannot apply the salary to me because it overrides the treaty. I will pay this money out to myself later as a dividend, and then Belgium will tax it, so there is double tax. And the court agreed. I mean, it first went to the High Court in Holland, which this is written in Dutch, but I'll give a brief translation. It said that Articles 15 and 16, which deals with salaries and directors' fees, do not define what they are, and therefore, based on Article 3.2 of the treaty, which is OECD moral standard, this must be allocated or interpreted along the lines of Dutch tax law. And then the court said, you know, that the meanings of these concepts, such as salary, must be interpreted dynamically, but the interpretation can't go so far that it effectively cancels the treaty in part by changing concepts used within the treaty in the national law. And then it said, you know, Holland crossed that border when in Article 12a it worked with this deemed salary, and it effectively moved the right to taxation one-sidedly from Belgium to the Netherlands. So the Dutch tax authorities appealed, and then the Dutch Supreme Court agreed with the High Court, and it said, first of all, it said, you know, it's okay. You can, under national law, you can tax income on the basis of deemed amounts under treaties. That is totally fine. But it says that it changes that, you know, when the legislator changes income, which under the treaty falls under one article, such that then the income is changed to something which under the treaty would fall under another article, which would allow Holland to tax it, whereas under the first interpretation it would not have been able to do so. This is not in line with Article 3.2 of the treaty, right? And finally it says in the final paragraph, in the current case, it concerns income of taxation of income, which is fictitious and which might still be paid as a dividend or as a capital gain in the future. And in that way, the fiction moves the right of taxation from Belgium to Holland, and that is simply not allowed under the treaty. So this was, I think, was a fair interpretation of Article 3.2. It was a fair interpretation of the boundaries of Article 3.2, and I think it is a good criteria. Do I actually move the right of taxation through my interpretation of the treaty? Because if I do, that is going beyond interpreting the treaty in good faith. The next case concerned the Dutch extra tax on shares, and You can see the case for citations and everything, and this concerns US and Holland, and you had a person holding shares in a Dutch BV, more than 25% of the shares in a Dutch BV, and the person emigrated to the US. And Dutch law says that if you emigrate, or if you stop being a taxpayer, basically a resident taxpayer, then you have a deemed sale of the shares just before the emigration, right? Because after the emigration, it's the other country that can tax. And then you get an assessment on your deemed gain, which is the fair market value minus the cost price of the shares. And that will be collected if you sell the shares within the first, I believe, 10 years after emigration. If you don't sell the shares in that period, basically the tax will never be collected. And so this person emigrated, got this assessment, final assessment, but not collected, and complained that this was against the treaty. And the Dutch Supreme Court said, that it is true that under Dutch law, if a substantial shareholder stops being a resident taxpayer, then there is a deemed sale right before the emigration. But that is before the emigration, so that does not mean that you can rely on the treaty to say you can't tax. However, the court said that if you do levy tax this way, it might still be that you are not acting in good faith with regard to the interpretation and the execution of the tax treaty. But for this particular case, the court said, if you look at Article 14.7 of the treaty, then the gains from the sale of shares are only taxable in the country where the resident, or where the seller is resident. But if you look at the official OECD commentary to Article 13, then you can see that it is not so that the gains from alienation of share is only due upon the sale. I mean, it is allowed for countries to tax an unrealized gain in the shares before immigration. So the taxpayer lost this case, and the court said there is no juridical double tax here. I mean, in the US, one would assume would indeed also give a credit for the subsequent sale of the shares if they are ever sold. If the US does not do that, that of course would create juridical double tax, but that may be many years down the line. This was how the law applied with regard to exit tax on sale of shares. It did not go the same way with pensions. So let's have a look at that. In our last case, of which you can see the details here, we had a situation between France and Holland where you had a Dutch individual living in Holland having pension rights with a third party where they built up during his career, and then he moved to France. And in Holland, historically, what happened was a lot of people had pension rights in Holland and then moved to Belgium, where they could simply redeem the pension rights at a very low tax rate. And to combat this, the Dutch authorities made a law saying that if you are going to move out of Holland, we will levy an extra tax on your pension, but we won't collect it if you don't do this redemption within the first, I think, 10 years. And so it's a bit like the shares, they as long as you don't sell the shares within the first 10 years, you won't pay tax. But if you do, you will pay Dutch tax. And again, it's the same fiction saying that you're deemed to have received all these pension rights just before you emigrated. But here things did not work out as planned, because the Dutch Supreme Court said, with regard to pensions, you can either look at Article 15 or you can look at Article 18. Now, Article 15 is current wages, and that's taxed wherever you do the employment. And Holland could tax that because the guy worked in Holland. However, Holland says no, this acknowledgement of the pension right is tax-free, and we'll tax the pension payment later. And then you go to Article 18, which deals with pensions. And the Supreme Court is a little preemptive, and it says, the way Holland made the law says that that the granting of the pension right is exempt under Article 15, and then later on you will tax the pension under Article 18. And they don't say that there's a return whereby this granting of the pension now becomes all of a sudden taxable under Article 15. But it also says, you know, this fiction can't work in such a way that you can pull the income from Article 18 back into Article 15, because once the salary has been paid and the exemption has been granted, that moment is over. At least that's the way I read the case. And then it talks finally about Article 18, and it says that if this fiction wasn't there, the emigration of this individual to France would have meant that only France can tax the pensions, right? And if you then have a fiction whereby all these pension rights become taxable in Holland just before immigration, that is not applying the treaty in good faith. And this cannot be changed by the fact that the law pretends that the person is still living in Holland. Now that the right of taxation is allocated to France the moment of emigration, you are frustrating the operation of the treaty in an unacceptable manner by creating this fiction that, oh, just before you emigrated you enjoyed the pension. So the tax authorities lost in this particular case, and I think these were interesting cases. You know, we start with Pierre Boulez, where clearly there's double tax and difficult to solve, as we saw, based on the different arguments. The Dutch laws, the different ones, potentially could create juridical double tax, but I think the Dutch Supreme Court has been doing very well in interpreting the law and the treaty in such a way that there is no juridical double taxation and that there is no treaty override. I hope you enjoyed these cases with me.